So how does a massive health insurance company just, find an extra $180 million in a single quarter?
Well, by proving to the federal government that their customers are actually a lot sicker than anyone originally thought.
Right. Which sounds totally backward.
It really does. It's like the ultimate counterintuitive reality of the Affordable Care Act risk adjustment model.
Yeah.
But, it is the absolute linchpin to understanding one of the most aggressive financial quarters we've seen in the managed care space in a long time.
I totally agree. And welcome, everyone, to today's deep dive. We're digging into the Q2 2026 earnings call for Centene Corporation, ticker CNC.
Yeah, and this is a massive quarter.
Oh, it completely shattered expectations.
Yeah.
Look, whether you are an investor looking for some actionable insights, or maybe a healthcare pro trying to figure out where the industry is heading, or, you're just insanely curious about how a multi-billion-dollar insurance giant handles government regulation.
Right, there's a lot to unpack.
Exactly. Our mission today is to translate all this Wall Street jargon into plain language, because Centene raised their full-year earnings guidance by over 40%.
Which is just a huge jump.
Yeah, a massive $1.40 per share leap. So I guess my first question is, when a managed care organization of this scale prints $44.4 billion in premium and service revenue in just 90 days.
Just an unbelievable number.
Right. And they raise guidance by that magnitude, we really have to break it down. Because doing that while actively losing millions of Medicaid members and facing a really hostile regulatory environment in Medicare Advantage, it's honestly an operational paradox.
It is. And the initial reaction from the street definitely reflected that paradox. Analysts were really struggling to reconcile this shrinking Medicaid footprint with these expanding margins.
Yeah, like how are you getting smaller but more profitable?
Exactly. To understand how management pulled this off, you kind of have to look beyond just the top line revenue. You have to dig into the actuarial maneuver.
The defensive pricing strategies, right?
Yeah, the stuff from like 18 months ago that is just now finally bearing fruit. And honestly, a pretty ruthless approach to enterprise optimization.
Well, let's start right at the top with that adjusted EPS number, because Centene posted $2.51 for Q2. But CFO Andrew Asher kind of immediately threw a flag on the play there.
He did, yeah. He was very quick to clarify that.
Right. He explicitly carved out 50 cents of that $2.51 as a non-recurring out-of-period benefit. And the breakdown there was $180 million from a favorable marketplace risk adjustment and $160 million from a Medicare settlement.
And both of those were tied back to 2025.
Exactly. Now, look, I understand wanting to set a clean baseline so Wall Street analysts don't bake that extra 50 cents into their 2027 one-rate models. But is this just, accounting loose change they found in the couch cushions? Or does this signal something systemic about how they reserve their capital?
I'd say it signals a highly conservative approach to incurred, but not reported claims, or IBNR.
Okay, break that down for us.
Sure. So in this macro environment, utilization trends have been just incredibly volatile post-pandemic. The absolute worst thing an insurer can do right now is under reserve.
Because then you get caught short when the bills actually come due.
Precisely. So Centene essentially took a very defensive posture back in 2025. They saw the utilization spikes happening across the industry. They priced for it, they reserved capital for it, and then they just waited.
Waited for the actual claims to settle.
Right. They waited for the ultimate claims run out and for the industry-wide data reconciliation to clear.
So when you suddenly get a $180 million positive adjustment, it basically means your internal telemetry was actually more pessimistic than reality.
I gotcha. So Asher is carving it out because he wants the street to value the core operating engine on its actual ongoing merits, not on this one-time release of conservative reserves.
Exactly.
Which is smart, right? Because if you let the street model a $4.80 EPS base heading into 2027, and 50 cents of that was just a one-time true-up, you are setting yourself up for a catastrophic miss next year. Yeah, you'd effectively be manufacturing your own headwind. Management really wants to control the narrative around their growth. By isolating all that out-of-period noise, they forced the market to look at the underlying cash generation.
Which was staggering this quarter.
Unbelievable. They generated $3.6 billion in operating cash flow.
That's massive. And what they chose to do with the chunk of that cash is what really caught my eye.
Oh, the debt repurchase.
Yeah. In a quarter where they are clearly feeling confident, they took $260 million and repurchased senior notes. That drove their debt-to-capitalization ratio down from 46.5% at the end of last year, down to 41.6%.
That's a huge drop in just a few months.
Right. Now, in the zero interest rate environment we had a few years ago, you'd probably want them deploying that capital for like aggressive growth or share buybacks. But in a 2026 macro environment where the cost of capital is structurally higher, this deleveraging feels like an offensive move disguised as a defensive one.
That is the exact right way to frame it. I mean, debt service in a high SLR environment is just a margin killer for highly leveraged peers right now.
Yeah, the interest payments just eat you alive.
Exactly. So by aggressively pulling down that debt-to-cap ratio to 41.6%, Centene is essentially unencumbering its future cash flows. Management even used the phrase, creating capacity to seize future opportunities.
Which is corporate speak for we want dry powder.
Yes. When you aren't bleeding yield to bondholders every quarter, you have the cash to execute on M&A if, say, a regional health plan suddenly becomes distressed. Or, you can fund massive internal tech investments.
Which we definitely know they are doing, and we'll get into that AI stuff later because it's wild. But let's look at the operating metrics that actually generated all that cash.
The margins were really impressive.
Yeah, let's translate some jargon here. The consolidated HBR, that's the health benefits ratio, basically the percentage of premiums spent on actual medical care, it dropped an incredible 340 basis points year over year.
Landing right at 89.6%.
Right. And on a $44 billion revenue base, pulling 340 basis points out of medical costs is a seismic shift in profitability. And simultaneously, their SG&A ratio, so the selling, general, and administrative expenses dropped to 6.9%.
Which is just incredibly rare to see happen at the same time.
Exactly. For you listening, think of it this way. If HBR is the cost of the ingredients for a restaurant, SG&A is the cost of the waitstaff and the electricity. Normally, if you want to lower your ingredient costs, you have to spend more on management to find better deals.
Right. You hire more care managers, you invest in utilization management software, your overhead goes up, but your medical costs go down.
But Centene is somehow buying cheaper ingredients and running a more efficient kitchen at the exact same time. How are they compressing both sides of the equation simultaneously?
Well, it's kind of the holy grail of managed care, right?
Yep.
Achieving that simultaneous compression really speaks to their massive scale.
Yeah, the sheer size of the operation.
Exactly. They are generating so much premium revenue that even with targeted investments in, like clinical interventions, the fixed costs of the enterprise are just being amortized over a much, much larger denominator.
Makes sense.
But I do want to caution against assuming that 89.6% HBR is the new permanent floor. We really have to contextualize that number within the massive shifts happening in their Medicaid risk pool right now.
Because that pool is actively shrinking.
Actively and rapidly shrinking.
This transitions perfectly into the whole Medicaid puzzle. And honestly, shrinking is putting it mildly. They ended the quarter at 12.1 million Medicaid members.
It was a big drop.
Huge. And management even admitted this attrition was steeper than their internal models predicted. They actually revised their full-year attrition forecast from 6% up to a range of 8 to 9%.
Yeah, this is the long tail of the public health emergency unwinding, colliding with some really proactive state-level tightening.
So states are basically scrubbing their rolls, they're kicking people off.
Exactly. The macro environment for state budgets right now is really stressed. Federal matching funds have normalized. Tax receipts in several key states are, they're softening a bit. So governors are looking at their Medicaid line items and realizing, they need to trim the fat before the new legislative frameworks take effect.
And that brings us to the massive legislative elephant in the room. OB3, the One Big Beautiful Bill Act.
Yes, the big one.
Now, before we dig into this, we have to set a very firm boundary for you listening. OB3 is heavily politicized legislation. It introduces some really stringent work requirements for Medicaid beneficiaries, and it significantly rolls back federal funding for Medicaid expansion populations.
It's a very controversial bill.
It is. So for the purpose of this deep dive, we are completely ignoring the politics. We are not making any value judgments on this legislation whatsoever. Both sides have strong feelings, but we are not taking a side. We are analyzing this strictly through the lens of a publicly traded company.
Right. Looking at how an insurance giant adjusts its core business model to survive this new reality.
Exactly. How they prepare for this legislation passing and being enforced by state governments.
And I'm really glad you framed it that way, because Centene's management is treating OB3 entirely as a logistical and actuarial variable.
It's just math to them.
It's just math. The law changes the eligibility criteria, which then changes the membership churn, which ultimately changes the risk pool. CEO Sarah London actually dedicated a significant amount of time on the earnings call to detailing their operational countermeasures.
Right, specifically around those ex parte renewals.
Yeah, and the data exchange piece of this is fascinating.
It really is. So just to clarify for everyone, ex parte renewals essentially allow a state to automatically renew a member's Medicaid eligibility by pinging existing databases. So looking at wage data, S&P benefits, unemployment claims, that sort of thing.
Right. So the member doesn't have to manually submit a giant stack of paperwork.
Exactly. And Centene is investing heavily in near real-time data pipelines to facilitate this for the states. But I got to be honest, the cynic in me looks at state-level IT infrastructure, which is notoriously archaic and broken. And I just wonder, how does Centene expect this to actually work at scale?
Well, the skepticism is totally warranted.
Yeah.
But Centene's strategy here isn't just, altruistic. It's really about self-preservation.
How so?
When states conduct manual redeterminations, the administrative churn is massive. People who are genuinely eligible lose their coverage simply because they moved to a new apartment and didn't get the renewal letter in the mail.
Oh, so they just fall through the cracks.
Exactly. And when that happens, Centene loses that premium revenue. Meanwhile, the member's health often deteriorates because they can't afford to see a doctor. So when they inevitably re-enroll 6 months later, their medical acuity is way higher.
Meaning they're sicker and way more expensive to treat.
Exactly. So by funding and building these API bridges for the states to execute ex parte renewals, Centene is aggressively defending its top line. They're keeping the healthy people on the books.
Wow, so they are effectively doing the state's IT work to protect their own revenue stream.
Pretty much, yeah. And they are taking a very similar approach to the work requirements mandated by OB3. You can't just passively hope your members remember to report their work hours to the state.
Right, because if the state kicks them off, Centene loses the premium, so what are they doing?
Management talked about rolling out this nationwide playbook. They're leaning on programs they've already piloted in 17 different states to actively connect members with community engagement, education, or job training.
Wait, really? Because if the member doesn't hit those OB3 engagement metrics, they drop off the roster? So Centene is deploying its own care coordinators to manage eligibility compliance.
Exactly. They're not just managing diabetes or hypertension anymore. It's a massive expansion of what a health insurance company traditionally does. They are essentially operating as a shadow workforce development agency.
That is wild. They are helping people find jobs just so they can keep them as insurance customers.
Yeah, because the financial ROI of keeping that member on the books totally justifies the extra SG&A spend.
But this brings us to the core actuarial dilemma, right? The whole rate versus acuity tug of war. We know how this attrition works. The people who drop off the Medicaid rolls first are usually the healthy ones.
Yep, almost always.
They are the ones who maybe got a job that puts them just over the income threshold, or they are the ones who just don't bother navigating bureaucracy because they haven't needed to see a doctor in 2 years anyway.
Exactly.
The people who fight tooth and nail to keep their coverage are the ones who are actively utilizing the healthcare system, the people with chronic conditions.
Right, the high utilizers.
So the 12.1 million members Centene has left are inherently sicker. The average acuity of the pool is rising. Wait, if the healthiest people are being kicked off Medicaid, doesn't that inherently wreck an insurance company's margins? How are they surviving this?
Well, this is the exact dynamic that absolutely crushed Medicaid margins for several regional plans over the last 12 months.
Yeah.
You lose the healthy premiums that basically subsidize the sick members.
Right. So how did Centene avoid that trap?
They countered it by securing a 5% composite Medicaid rate increase from their state partners. And that's up from their previous forecast of 4.5%.
Okay, I have a really hard time believing that state Medicaid directors who are already dealing with huge budget shortfalls just rolled over and handed Centene a 5% rate bump out of the goodness of their hearts. How on earth did they extract that much yield from the states?
It all comes down to data superiority and actuarial transparency. Centene didn't just walk in and demand 5%. They brought their massive localized claims data and said, look at the utilization. Your remaining population is generating higher HCC codes.
Meaning more severe diagnoses.
Right. They showed the states, look, their pharmacy utilization is up 12%, and their behavioral health costs are structurally higher now.
So they brought the receipts.
They brought the receipts, and they told the states, if you want us to maintain network adequacy and hit the quality metrics you demand, the per member per month capitation rate has to reflect the actual morbidity of this new sicker pool.
Wow. And because states are legally required to provide actuarially sound rates, and Centene had the localized data to prove this acuity shift, the states basically had no choice but to adjust the rates upward.
Exactly. It's a true testament to having a massive localized footprint. You can't negotiate with a state based on national averages. You have to show them their own citizens' specific claims data.
Right. The localized data is the leverage. And CEO Sarah London made a point to emphasize that this isn't just about, collecting higher premiums to cover higher costs. She highlighted their clinical interventions.
Yes, this is a huge piece of the puzzle.
She noted that they are targeting 75% of their Medicaid health plans to hit 3.5 or more NCQA stars. So what does that mean in plain English?
The NCQA star ratings are critical here.
Right.
If you are going to manage a higher acuity population, your care management has to be absolutely flawless.
You can't just take the 5% rate bump and then let everyone show up in the emergency room.
Exactly. London specifically called out that core medical costs, particularly in behavioral health, are stabilizing despite the higher sickness level of the pool.
That's a big deal.
It is. It's hard evidence that their clinical interventions, like putting care managers directly in the community, addressing social determinants of health, are actually dampening the utilization curve.
So they're keeping people healthier, which keeps costs down.
Exactly. They're keeping the Medicaid HBR anchored at a target of 93.5% through sheer operational force.
All right, let's shift gears from the state safety net to the commercial market. Because if the Medicaid narrative was all about defending the fortress, the marketplace segment was an absolute victory lap for management.
Oh yeah, they crushed it here.
We are talking about the Affordable Care Act exchanges. Centene raised their pre-tax margin estimates for this segment to a range of 4.5 to 5%. That is a massive revision from their previously cautious 3% estimate.
A huge leap.
And they did this while maintaining a remarkably stable membership of 3.5 million, totally defying the usual Q2 seasonal attrition.
And that lack of seasonal attrition is actually a really fascinating macroeconomic indicator.
Oh, so?
Well, historically, you'd see ACA membership peak in Q1, right? And then it would sort of bleed down slowly as people gained employer-sponsored coverage throughout the year.
They get a new job, they drop the exchange plan.
Right. But the fact that 3.5 million members are sticking with Centene's exchange plans all the way through Q2, it suggests a real stickiness in the gig economy and really a broader structural shift in how Americans are sourcing their health insurance.
That makes a lot of sense. People are staying independent longer.
Exactly. But, the real story of this massive margin expansion isn't just membership stability. It's the Wakely validation.
The Wakely report. Sarah London essentially paused the earnings call to take a bow on behalf of her actuarial team regarding this report. Let's unpack the mechanics here, because this is exactly where that $180 million windfall came from.
It is.
So Wakely is an actuarial consulting firm that acts as a sort of industry-wide clearinghouse for risk adjustment data, right?
Exactly. And to understand the drama here, and it really is corporate drama, you have to rewind to the pricing environment in early to mid-2025.
Setting the stage.
Right. Across the entire ACA marketplace back then, insurers were getting hammered by unexpected spikes in medical utilization.
Surgeries that were deferred during the pandemic were suddenly being scheduled. Pharmacy costs were surging.
Exactly. And several of Centene's competitors just totally panicked. They assumed this was just a permanent shift in baseline utilization, that people were just, using more healthcare, regardless of how sick they actually were.
Just overutilizing the system.
Right. But Centene's actuaries looked at their internal data and came to a totally different conclusion. They looked at the claims and realized, wait, this isn't just arbitrary overutilization. Our members are legitimately generating complex diagnoses. They are actually sicker.
And that distinction is everything in the ACA risk adjustment model, isn't it? Because the ACA is designed to remove the incentive for insurers to cherry pick healthy people.
Yes. If your membership pool is mathematically sicker than the state average, the insurers who have healthier pools have to transfer funds to you to subsidize your higher medical costs.
It's a zero-sum game within each state.
Right. So in mid-2025, Centene's team made a massive, highly calculated bet. They assumed their internal data was correct, that their members were legitimately sicker, and therefore they would be owed massive risk adjustment transfer payments in the future.
So they priced their 2026 bids defensively, baking in this assumption.
Yep. And they absorbed all the short-term skepticism from the market.
And they had to just hold their breath until June 2026, when Wakely finally published the aggregated industry-wide claims data that actually confirmed who was sick and who was healthy.
And the Wakely data vindicated Centene's actuaries completely.
Wow.
It proved that Centene's relative risk adjustment position was exceptionally strong. Their members were, in fact, generating high acuity claims compared to the market average.
Here's where it gets really interesting for you as a listener. Centene essentially bet that their members were legitimately sicker, not just overutilizing care. Wakely proved them right, meaning the government risk adjustment payouts covered all those high medical bills. That validation is what triggered the $180 million favorable reconciliation.
Exactly. They didn't just stumble into a pile of money.
Yeah.
They accurately modeled a highly complex demographic shift 18 months in advance and priced their product to capture the upside.
It really is a masterclass in risk coding. And management gave some color on exactly what was driving this acuity. They noted higher utilization in their silver tier plans, specifically driven by chronic conditions like oncology and anti-inflammatory specialty drugs.
Which ties directly into HCC hierarchical condition category coding.
Explain that for us.
So, in the commercial market, if you pay for a $10,000 oncology treatment, but your network fails to properly document and code the patient's HCC status to CMS, you just lose $10,000.
Just gone.
Gone. But if your provider network is tightly integrated and accurately codes that exact same oncology diagnosis, that HCC weight flows into your risk score. And the Wakely reconciliation ensures you are compensated for taking on that risk.
So Centene's ability to actually capture and document that chronic acuity is what unlocked the margin.
Exactly. It's all about the documentation.
Now, before we leave the commercial market, I want to spend some real time on a metric that might seem like a footnote, but I think represents a massive macroeconomic tectonic shift, ICHRA, individual coverage health reimbursement arrangements.
Yes, this is a huge trend.
Centene noted their ICHRA membership grew 2.5 times, reaching 50,000 members. Now look, 50,000 is a drop in the bucket for a company with tens of millions of members, but the trajectory here is wild.
The trajectory is wild because ICHRA fundamentally rewrites the employer-sponsored insurance model. For the last 70 years, the standard has been a defined benefit model, right?
Right. Your employer picks a corporate health plan from a major carrier, they negotiate the rates, and you just take what you are given.
Exactly. But healthcare inflation has made this totally unsustainable, especially for mid-size employers.
Yeah, if you are a 500-person company and your group plan carrier hits you with a 15% premium hike, you just have to eat it or pass it on to your employees.
ICHRA shifts the market from defined benefit to defined contribution. Under ICHRA, that employer can say, look, we are no longer managing a group plan. Instead, we are giving every employee $600 a month tax-free. Go onto the ACA exchange and buy whatever plan fits your family.
That is huge. The employer completely caps their financial exposure, and the employee gets portability and actual choice.
Exactly.
But this is an existential threat to the legacy commercial carriers who rely on massive, sticky employer groups. But for Centene, whose entire chassis is built for individual direct-to-consumer exchange products, ICHRA is a massive tailwind.
It really is. If thousands of employers start dumping their workforce onto the individual exchanges via these defined contributions, Centene is already the dominant player waiting to catch them.
Because they have the network design, the consumer marketing apparatus, the pricing algorithms, all optimized for the individual buyer.
Right. If ICHRA adoption continues its current J-curve, those 50,000 members could easily become 500,000 in just a few years. It represents a highly profitable, really low acquisition cost growth vector for them.
All right, let's move to a segment that is experiencing the exact opposite of a tailwind. The Medicare Advantage space right now is an absolute bloodbath.
It's really rough out there.
And CEO Sarah London was refreshingly blunt about it. She explicitly called out the artificial cut point increases and overall STARS program methodology changes. Now, when the CEO of a highly regulated entity uses the word artificial to describe CMS methodology, I mean, it means the friction between the payers and the regulators is at a boiling point.
The frustration is palpable across the entire sector. Look, the Medicare Trust Fund is stressed, and the government has realized that the quality bonus payments they've been handing out to Medicare Advantage plans for hitting 4-star and 5-star ratings are costing them billions.
So what did CMS do?
They didn't just change the rules, they changed the grading curve entirely. They moved the cut points up, making it mathematically much harder for plans to achieve the star ratings necessary to unlock those bonuses.
And without those bonuses, you can't fund the $0 premiums or the extra dental and vision benefits that attract seniors in a hyper-competitive market, so your margins just get crushed.
Exactly. The vicious cycle.
So in response to this really hostile environment in standard Medicare Advantage, Centene is executing a fascinating pivot. They are actively shrinking their standard MA footprint and doubling down on D-SNP dual-eligible special needs plans.
Which is a very specific niche.
Right. These are plans designed specifically for individuals who are so low income and have such complex medical needs that they qualify for both Medicare and Medicaid. And D-SNP now makes up 40% of Centene's MA portfolio.
It's a huge shift.
But if standard Medicare is getting harder to turn a profit on, why double down on the poorest, most complex patients? To a layman, pivoting away from relatively healthy seniors to focus on the sickest demographic in the country seems like a terrible way to fix your profit margins.
I get why it looks that way, but you really have to look at Centene's corporate DNA.
Because they are a Medicaid company at their core.
Exactly. If a traditional commercial insurer tries to manage a dual-eligible patient, they usually fail. Because that patient's needs aren't just medical. They are deeply tied to social determinants of health, food insecurity, housing instability, lack of transportation.
Stuff traditional insurers don't know how to handle.
Right. But Centene has spent 2 decades building localized networks to address those exact issues in their Medicaid populations.
So they are just leveraging their existing infrastructure.
Exactly. The dual-eligible patient is already interacting with the state Medicaid system for their long-term care or behavioral health, and the federal Medicare system for their acute care. Historically, those two systems do not talk to each other.
Which creates massive inefficiencies, I imagine.
Huge. The patient falls through the cracks, ends up in the ER, and costs both systems a fortune. By enrolling that patient in a Centene D-SNP plan, Centene integrates both funding streams.
Oh, that makes so much sense. They can use the Medicaid infrastructure they already own to manage the patient's holistic needs, preventing the acute episodes that drive up Medicare costs.
Exactly. Furthermore, because these patients have incredibly high clinical acuity, the risk adjustment revenues from CMS are significantly higher.
It's a strategic retreat to higher ground. London is effectively saying, look, we aren't going to fight a margin war over healthy 67-year-olds who just want a free gym membership. We are going to dominate the complex, high acuity niche where our operational moats are deepest.
That's spot on. And she even noted they expect the MA business to hit break even or better by 2027 based specifically on this D-SNP strategy.
It's a really highly disciplined approach to capital allocation. But we also need to touch on the other side of their Medicare business, which is actually thriving right now.
Yeah.
The prescription drug plans, or PDP. They actually raised their PDP pretax margin guidance to greater than 3%.
Which is pretty shocking given the massive disruption caused by the Inflation Reduction Act.
Right. The IRA completely redesigned the Part D benefit. It capped out-of-pocket costs for seniors and drastically shifted the liability in the catastrophic phase away from the government and directly onto the insurers. Everyone assumed PDP margins were going to just collapse under the weight of those new liabilities.
The fear was definitely there. I mean, Centene manages a staggering $60 billion in annual pharmacy spend.
That is a massive liability.
But with a year of post-IRA data now available, management has a really firm grip on the new utilization patterns, and they leaned heavily into their partnership with Express Scripts, their pharmacy benefit manager.
Because size matters here.
Exactly. When you have $60 billion in purchasing power, you can force pharmaceutical manufacturers to the table. They leverage that scale to secure much better rebates and discounts, effectively insulating their margins from the IRA's catastrophic phase liabilities. The scale is basically their shield.
Okay, so we've dissected the actuarial gymnastics in Medicaid, the Wakely windfall in the marketplace, and the strategic pivot in Medicare. The obvious question is, how does a single corporation manage all of these highly volatile, deeply complex regulatory changes without just collapsing under the weight of its own bureaucracy?
And that brings us to the most forward-looking part of the whole earnings call.
Enterprise optimization and their AI strategy.
Yes.
Management disclosed a massive $480 million SG&A investment focused strictly on enterprise optimization.
Which is huge. I mean, in a quarter where they are relentlessly driving down SG&A everywhere else, Carving out nearly $500 million for internal tech investment requires immense conviction. It tells you that they view this not just as an IT expense, but as fundamental operational infrastructure.
Look, I'm naturally skeptical of AI talk on earnings calls. Right now, it feels like every CEO is legally obligated to say generative AI 3 times a quarter just to keep their stock price up. It feels exactly like the blockchain craze of 2018.
Oh, totally. The buzzwords are everywhere.
But Sarah London's commentary was surprisingly granular here. She explicitly distanced Centene from the disjointed sort of app-based AI use cases. She didn't talk about customer service chatbots. She talked about building trusted data products and dynamic context management.
And that phrase, dynamic context management, is really the key to understanding how AI actually scales in a highly regulated enterprise.
Break that down.
Think about what a health insurance company actually is. Under the hood, it is essentially a massive data repository. Decades of claims data, provider network contracts, clinical guidelines, and really specific state-by-state regulatory rules.
Right.
If you just plug a generic large language model into that unstructured mess, it's going to hallucinate badly. It might approve of spinal surgery in Texas, but then deny the exact same surgery in Florida simply because it pulled the wrong state's Medicaid guidelines.
Which would trigger immediate regulatory audits and massive fines. You just cannot have probabilistic algorithms making non-deterministic decisions in healthcare.
Exactly. So instead of buying off-the-shelf AI tools, Centene is spending that $480 million to structure their data foundation first. Dynamic context management means they're creating an architecture where the AI, regardless of whether it's an open AI model or some open source model, must operate strictly within Centene's proprietary, heavily governed business logic.
So they are basically abstracting the data from the AI model.
Exactly.
Yeah.
This means as AI technology commoditizes and evolves over the next 5 years, Centene's institutional knowledge remains secure and completely portable. They are building an operating system, not just downloading apps.
And we don't even have to guess if this works because they provided a very concrete, frankly mind-blowing example of an agentic workflow that is already live today.
The legal invoice review system.
Yes. They built an AI to audit their human lawyers.
It is so cool.
They're using an agentic AI, meaning a system that can take autonomous actions based on parameters, not just generate text to ingest and review the itemized invoices sent by their outside legal counsel. And this system is saving them 1.5 points on their monthly legal billings.
Which is a massive dollar figure for a Fortune 25 company engaged in constant litigation, regulatory compliance, and M&A contracting.
I just want to sit with the mechanics of this for a second because they literally built an AI lawyer to audit their human lawyers' bills. That is a ruthless, highly effective ROI.
It really is.
The AI is ingesting hundreds of pages of itemized legal bills. It is cross-referencing those line items against Centene's outside counsel billing guidelines. It is identifying inefficiencies like, say, a senior partner billing for routine document review that should have been done by a paralegal.
Right, or catching duplicate billing entries.
Exactly. And then it is autonomously adjusting the invoice and effectively telling the high-priced corporate law firm, we are rejecting these line items. It is a zero-emotion audit function.
And it is the perfect proof of concept for their broader strategy.
Yeah.
The ROI is immediate and it's easily quantifiable. It strips out administrative bloat in a way that human auditors simply cannot match in terms of speed or scale.
It proves that their foundational data architecture can actually support autonomous agents in the real world. Exactly.
All right, let's pull all of this together. We've gone really deep into the weeds of actuaries, legislation, and algorithms today. How do you synthesize the master narrative of this quarter for the listener who is just trying to figure out what this means for the broader healthcare landscape?
I'd say the master narrative is that Centene is executing a highly disciplined strategy of margin protection in an environment designed to erode margins.
Well said.
They aren't just growing their top line indiscriminately, they are optimizing the profitability of the revenue they already have. They correctly anticipated the acuity shifts in the ACA marketplace, and they had the discipline to wait for the Wakely data to prove it.
Yeah, the patience there was key.
Exactly. They used localized claims data to aggressively negotiate 5% rate hikes in a shrinking Medicaid environment. They are actively retreating from unprofitable segments of Medicare Advantage to defend their structural moat in D-SNP.
Just pulling all the right levers. Right. And they are deploying capital aggressively to deleverage the balance sheet, all while funding agentic AI to just crush their SG&A. It is a playbook of absolute operational leverage.
It really is a masterclass in pulling the right levers at exactly the right time. But before we wrap, I want to leave you listening with a concept to chew on that builds on everything we just discussed.
Yeah.
We just talked about Centene proving that agentic AI can aggressively reduce costs by auditing professional invoices in their legal department. They built an AI that successfully audits lawyers.
And generates a tangible ROI doing it.
Right. So if an AI is capable of ingesting complex legal billing guidelines, reading unstructured invoices, and autonomously denying payment to a law firm, how long until that exact same agentic architecture is deployed to the clinical side of the business?
Oh, wow.
Think about it. How long until AI systems are fully empowered to adjudicate, challenge, or outright deny actual medical claims in real time between doctors and insurers?
I mean, the underlying logic of the algorithm, cross-referencing an invoice against a set of rules, is practically identical.
Exactly. If the AI can read a lawyer's timesheet, it can read a doctor's electronic health record. We are rapidly approaching a reality where the hospital's billing AI submits a claim, and the insurance company's auditing AI immediately challenges the HCC coding or the medical necessity.
Fighting it out in milliseconds.
Right. When the entire financial bureaucracy of healthcare evolves into a hyper-fast battle of autonomous algorithms negotiating with each other in milliseconds, where does the human patient actually fit into that equation?
That is a very unsettling thought.
We started this conversation marveling at Centene's ability to navigate complex regulatory environments. But as these companies pivot to foundational AI, the regulations of the future won't just be governing people, they will be governing the algorithms that decide who gets care. It's definitely something to think about the next time you get an explanation of benefits in the mail. Thanks for diving deep with us.